let's continue on with our journey through inventory. So you guys would remember in yesterday's lecture. So let's just see on our roadmap where we at. So on our roadmap, we said that we've already discussed some definitions. We've looked at whether inventory is an asset or not, and we've also discussed the perpetual inventory system. We did that in lecture 1. And then lecture 1 and 2 on Tuesday, and then after that we started to move on to purchase costs and that initial costs, and so we've done that as well. That's basically been completed, so we're happy with that. Today we're going to continue, and yesterday we started, but today we're going to continue on with the conversion costs. So that's going to be what we're going to do today. We're going to do a lot more examples today than we did yesterday, because yesterday we were just trying to get comfortable with the theory. Now we want to sort of see how it works and see what it means for us. So we're going to do a few more examples today based on what we learned yesterday. And then Tuesday, we're going to talk just very briefly about other costs. So other costs is a bit of a more of a specialist topic. So we won't go in depth with other costs, but we're going to do that on Tuesday. Then Thursday, this is self-study, so I expect you guys to study this on your own. Thursday, we're just going to touch very briefly on FIFO and weighted average, and then specific identification methods of valuing cost. Right? We're going to do that very briefly. This is not, we're not going in depth here, and that's because obviously you've done it in first year, and if you're coming with accounting from high school, you've definitely done it in high school as well. So it's sort of quite an easy topic. You can expect not to see a big FIFO question in your tests or exams. You're not going to see a big FIFO or a big WAM or a big specific identification question. It's sort of considered a bit too easy at your level currently. Okay, but what is important for your level is going to be net realizable value, right? So that we're doing on Tuesday and Thursday. We're going to try and finish it off on Thursday. Very important. And then also on Thursday, we want to do some disclosures, right? So this section, the important disclosure is going to be that inventory note, right? We're gonna look at that, and we're gonna look at a few other things in disclosures then. Okay, so now I just want to do a quick recap of what we chatted about yesterday. So yeah, so I just want to do a quick recap of that. So this is a slide that we saw yesterday. So basically what we said is we spoke about the purchase costs. We're sitting here in conversion costs. We're not too worried about direct labor, because just like purchase costs, which is actually indirect, direct materials, purchase cost is direct materials. So just like direct materials, the direct labor will easily just be allocated into the cost of inventory. So we don't really need to worry about a method of allocation, you see, because of the fact that it's so easy to allocate the direct labor into the cost of inventory. So we're not worried about that too much. There's going to be a direct relationship. We're going to know exactly how to allocate it in our tests and exams. The one that we are concerned about is production overheads, and specifically fixed production overheads. Remember, we said variable production overheads, not too much of a problem, because it'll sort of work in the same method that the direct materials and direct labor works. And that is meaning that there will be a direct link between how we allocate it and how it's incurred. And so we're not going to have too much of a problem. The one that we need to focus on now are the fixed the fixed costs, you see. So the fixed costs, there isn't that direct relationship, right? There isn't that direct relationship between individual goods produced and how the cost is incurred and how the cost is compiled. So that's sort of where we're going to spend the majority of our time today, is trying to figure out how we allocate these fixed costs, you see. Okay. Now, yesterday, you'll remember we spoke just briefly about this. We said variable overhead costs, easy. We can just allocate the actual capacity. We can allocate the actual costs on actual capacity. With fixed, we said it's super easy to predict because it's fixed, right? So it's easy to predict the total cost, but the problem is allocating it to individual units as a costing exercise is difficult. So what we then do is we use this thing called our best estimate, right? And the way we labeled it was, we said we called our best estimate normal capacity. We said normal capacity is always expressed in a number of units, so it's a number of products. It's not a random amount. It's not any other type of unit. It's not any other type of number. It's a unit amount. It's meant to represent the number of goods, right? Okay. So then we ended off yesterday's lecture talking about the difference between incurred costs and allocated costs, right? And we said incurred costs are costs that, because of the accrual system, we have to pay, right? So we've stayed in this building for 1 month, therefore we've incurred rent for this building, right? We have to pay it. We need to create a liability for rent, right? That's an example of an incurred cost. And then allocated costs, we said as and when we produce goods, right? So on day 1, we produced 1 good. On day 2, we produced 2 goods, and so on and so forth. So as and when we produce goods, we would take a little portion of this incurred cost, right? So we're going to take a little portion of the incurred cost, which just, by the way, arrives in the expenses on the debit side. So it increases the expense, right? So it increases rent expense. It increases electricity expenses or whatever, right? Whatever fixed cost we're talking about. Actually, electricity is more variable, but let's just talk about rent. So it increases on the debit side of that account, right? So it makes the rental bigger, that makes the expense bigger. And then when we produce 1 or 2 or however many units of goods, we now are going to allocate that. So it goes on the credit side, means it comes out of that account, and then it ends up in the inventory WIP account, right? So we're going to take it into that WIP account. And at the beginning of Tuesday's lecture, I'm going to take you through just like all the accounts that we're dealing with, just so that we all have it fresh in our mind. Right. So is everybody happy with how this works? Everybody comfortable so far with the summary of last time's lecture, right? So just remember that the allocated costs, it's allocated based on the number that has been produced. So on day 1, we made 5 goods. Let's say we made 5 laptops or whatever we're producing. We'd say that times the application rate, right? And remember, when we spoke about the application rate or allocation rate, we said it's going to be the total fixed costs for the year, right? So that's going to be the total fixed cost there. We can predict it, so it's more likely that it's going to be the actual. So it's easy to predict. It's a cost that's easy to predict, and then we divide it by the normal production, right? And remember that normal production is our best estimate, right? And we get this rate that we call the allocation rate or application or absorption rate, and then we absorb that cost into inventory. Okay. Now, so this is just a recap again of sort of yesterday's lecture. We said variable production overheads, very easy to allocate. We just take the actual that we've incurred, and we divide it by what we've actually produced, and that gives us a cost per unit, basically. Right? So the actual variable cost divided by the actual production going to give us a cost per unit. And this is the same way that we would do direct materials, same way we would do direct labor. Okay, so there's no difference between that calculation, that per unit calculation for direct materials, direct labor, and variable overhead. Only the variable works like that, right? But now the fixed overhead, right? Okay, guys, the fixed overheads, we now take the fixed costs that are incurred, the total fixed costs, we divide it by this normal capacity, and then we multiply it by what we've actually produced at a given time or during a given period, right? So now, because the actual number is not always the same as the normal number, right? So it's not always the same. Actual capacity is not always the same as normal capacity. It means we have a problem because there's a likelihood that either the actual will be higher or be lower than normal capacity, right? So if the actual is higher, right, would we have allocated more or less costs to inventory? So I'll ask the question again. You guys are going to answer it for me. If the actual capacity is higher than the normal capacity, would we have allocated more or less costs than we should have? Right? What do you guys think? Right. If the actual capacity is more or is higher than the normal capacity, would we have allocated more or less costs? Shall we try it out with some numbers? Right. So let's say we've got fixed overheads of 100 Rand. Right? Then our normal capacity is 10. How much is our allocation rate, or how much is our absorption rate? Our absorption is going to be 10, right? Now, we said our actual capacity is higher, right, than our normal capacity. So it has to be, let's say, 12. Okay? So then we're going to take our 10, which you guys calculated, right? You happy? You know where we got this 10, right? Right? You know where we got this 10. Right? We got this 10. This is the absorption rate. We're going to take that 10. It's going to give us 120 Rand. So now have we absorbed more or less than we should have? We've absorbed more. And we only incurred costs of 100, meaning we were only, the landlord only charged us 100 Rand. But when calculating our inventory, we inflated and we transferred too much costs. So this account, if we have a look at this account here, this account now is sitting in a credit, right? This expense account, whatever, rental expense, whatever, it's now sitting in a credit because we only got 100. So again, we only got 100 in here, but we've now taken out 120. So we've got a credit here of 20 Rand. You see the problem that we have, right? So in that situation, we call that an over recovery, right? We've tried to recover too much costs out of inventory. We've tried to add too much value to inventory, right? We call it an over recovery. Does that make sense? Okay. And then obviously the inverse also is true, right? So if we had actual of 8, we would have only recovered 80 Rand, which means we would have under recovered, right? We would have under recovered. Any questions so far? Does everybody understand? Everybody understand what we've been saying so far? Shall we do another example then? Let's do another example and let's see if we get it, if it makes more sense to us now. Right. So this example says we've got estimated fixed production overheads, estimated fixed production overheads of 200 Rand per year, right? So what is this? This is what? What's another word for this? We can call that total fixed production overheads, right? So if we go back to our diagram, where's our diagram? If we go back to our diagram, that 200 Rand is this number, all right? That's what they're trying to tell us in this example, right? So let's read it again. We've got estimated fixed production overheads of 200 Rand per year. It's the total for the year, right? Cool. Now we're told that the normal capacity, right? Normal capacity is 20 units. Normal capacity is 20 units. That's our best estimate of how we plan to produce, right? Our best estimate of what we plan to produce. Okay. Now the question that they're asking us is, what is our estimated fixed cost per unit? How are we during the year going to allocate this fixed cost? What is the absorption rate, right? So how we're going to get that amount is we're going to say 200, right? Everybody know where I got the 200 from, right? Divided by 20 units, right? That's what we expect to produce. It's going to give us 10 Rand, right? Most people understood so far. Anyone's lost so far? You have to tell me if you are lost, because I won't know, because in class I can look at your face and I can say, hey, this person's lost. But now, can't do that. Okay. Right. So that was at the beginning of the year. That was in January, right? So now during the year we started producing. We're producing, and every year we produced, every month at least, we produced little bit. Eventually, at the end of the year, we had produced 22 units, right? So it's higher, it's more than what we had intended to produce. You see, we produced 22 units. So then it's saying how much of the total fixed, or what was the total fixed cost that we had allocated during the year, right? So what cost did we eventually allocate, right? And then how would we come up with that amount? We'd say 22, which is what we actually produced, right? Multiplied by a rate of 10 Rand, right? Everybody knows where I got the 10 Rand from, right? It's going to give us 220. The problem is we were only charged by our landlord, we were only charged 200. You see, therefore, the net between these two, right? So we're going to say 220, which is what we allocated, right? Let's put an A here, right? We'll put an A there, meaning allocated. And then we'll say less the 200 Rand, which was, what's the word for that? Incurred. So we'll put an I there. Everybody happy with that? Right? Gives us an over recovery, means we try to recover too much of how much? 20 Rand. Right? Okay. Okay, so let's just quickly have a look. So this is what we're saying here. We're saying at the beginning of the year, right? At the beginning of the year, right? We came up with this calculation of 10 Rand per unit at the beginning of the year. We didn't know how much we're going to produce. Remember, the reason, the whole entire reason for normal capacity is because we cannot predict how much we're going to produce, you see. So at the beginning of the year, when we didn't know, we used 20 as a best estimate, right? We came up with a unit price per good, right? Per unit at least of 10 Rand. We then allocated during the year, right? Throughout the year, a little bit every month, a little bit every time. We allocated. We allocated 220. Okay. Now it says here, let's assume that our fixed costs, our actual fixed costs, always equal our estimated fixed costs. So it's sort of saying what I was telling you, where I said for back to 100, let's just assume we can predict, We can always predict this 200 Rand accurately. We're never wrong. We always predict this 200 Rand accurately. That's what this statement is saying for us. All right? And so now the question is, what happens? All right. So that's how it would look like with numbers. Let's see what it might look like if we were to put it into T accounts, right? Because everyone loves T accounts. Okay. Everyone loves T accounts, you see. So now, just bear with me. All right, so we came up with this expense, right? So our fixed overheads is going to be an expense, right? So let's assume it can be many things. We can call it rental, we can call it whatever, right? Okay. So, and then we credited our expense, meaning we tried to decrease our expense, right? And we decreased it by 220, right? Happy? We decreased it by 220. Where did we put it? We ended up putting it in the inventory account. Now I know what you're going to say. We didn't put it directly in the inventory account. We put it in the WIP account. But for our purposes of this example, let's just assume that for now, let's just think about it as one account. So you do realize that raw materials, work in progress, and finished goods are all considered inventory, right? They're all considered one thing, right? They all are inventory. So if I'm saying here that we're just going to use an inventory account, I understand that it's not 100% accurate, but the thing is, in our example here, we're not looking for that split. Our example is not interested in that split. We're interested in something else, right? So just bear with me. So anyway, we credited the expense. We debited this fellow here, inventory account. Right. Everybody happy so far? You know what's happening, right? Now, during the year, we sold goods, right? We sold the goods. And what happens when you sell goods? What's that journal entry? It is debit, cost of sales, credit, inventory, right? So we did that. Now, let's assume we sold all the goods that we've produced, right? So we sold everything that we produced, which means we would have debited our inventory for the full 220. I mean, we had credited at least our inventory for the full 220 and therefore debited the cost of sales for the full 220. Make sense? Right. Now that leaves us with a problem, right? You guys know what the problem is, right? Revenue and cost of sales, they have a baby, and that baby's name is gross profit, right? Now the problem is our gross profit is going to be too small, right? Because revenue came in at whatever amount, we don't know what amount it came in, but now when the cost of sales came in, we brought it in at an amount, at a cost that we never incurred. You see that? We never incurred that extra 20 Rand. You see that? So we're bringing it in at an amount that we never incurred. So we have to do what? What do we have to do? And you also got to remember now what's happening is this account is now sitting at 200 less 220. So we're actually sitting here with a credit. Right? So on one account in the income statement under expenses, we've got a credit, right? And then in cost of sales, we've got a debit, but the debit is too big. So what do we need to do? We need to decrease the cost of sales account. That's it. So let's start there. Cost of sales is an expense, so it decreases on the credit side, right? Happy? So we could decrease the cost of sales account. And then we need to eliminate the credit that's sitting in. Let's assume this is called rent expense. We need to eliminate that credit sitting in rent expense. So we then we credit the cost of sales and we going to debit the rent expense account. So this, at the end of the year, it brings this account to nil, right? Which is fine, right? That's what we wanted. We wanted to allocate all the costs that we incurred, which we've done with this last journal entry. Okay. Does everybody understand now what an over recovery is and how you pass the over recovery, and passing a journal for the over recovery is what we're trying to do is we're trying to make sure that the account reflects what actually happened, right? The accounts reflect what actually happened, which means now our cost of sales is actually sitting now. So if we have to draw a balance, which you'd never do in cost of sales, but anyway, for example, we will. Our cost of sales is actually sitting at 200 Rand. How much did we incur? We incurred 200 Rand. Our rental is sitting at 0. That's because we incurred 200 Rand and we eventually got rid of it in its entirety. And our inventory, we'll assume that we sold all the inventory, so it's sitting at 0. Yes. Can you explain the inventory T account again? Okay. No. Please explain why you started off by crediting the overheads. We didn't credit it first. We debited it with the cost that we incurred, right? Then we moved that cost out with the cost that we allocated into inventory. Okay, that's the in-between account, right? We moved it into inventory, and then as we sold the inventory, we moved the inventory out of the inventory account into this expense account, cost of sales account. Must I explain again? So we incurred 200 Rand of rent, right? During the year, piece by piece, day by day, we allocated 220 Rand to inventory, right? That's because this, whatever cost it was, whether it was rental or whatever, it was a production cost, right? It was a fixed production cost. So we allocated it to inventory, but then we sold the inventory. So then we have to put that inventory in cost of sales, right? So that's what's going on there. And then from inventory, oh, it's inventory. And then from inventory, I mean, from cost of sales, we had a cost of sales that was too high and a rental expense that was basically in a credit, which was not right. So we needed then to move this 20 there. That's what happened. Okay, any other questions? So someone's asked the detail on fix the detail. On fix this one here. You mean the account name? What's the contra account? The contra account is cost of sales. We're decreasing the cost of sales by moving it into by undoing the over recovery. Right. Let's have a look at this one. This is where the answer is. Right. So this is what we said. So we said now we debited it with bank, we incurred it, we paid it to the landlord, right? The rent. We paid the landlord 200 Rand. We then allocated 220 into WIP, right? We allocated the 220 into WIP, and from WIP, it's now ended in cost of sales, right? Via the methods, it has to go to finished goods. From finished goods has to be sold. It's ended now in cost of sales, and then the cost of sales is too high, and the rental is in credit, which is no good. So therefore, we undo the over recovery by moving that extra bit, the part that was over recovered, we move it into cost of sales. You don't understand why we credit cost of sales at 20, because we've brought in 220, right? Do you understand that we brought into cost of sales 220? Everybody understands that we brought in 220. Where did we bring it in from? From inventory, right? The problem is we didn't incur 220. We only incurred we only paid 200. So we're making it seem like we paid 220, but we never paid 220. So we need to decrease it back to the amount that was actually incurred. So we decrease it by 20, which brings the total of this account at the end of the day, brings it to 200, which equals what was incurred and what we paid via the bank. Still, any questions now? Does everybody understand that? Okay. Now that was an over recovery, right? So that was a situation. So if you have a look at this thing here, right? This is the slide that we just looked at. If you have a look at this, this was a situation where we had normal production or normal capacity of 20, but we produced more. Now the question next is, what happens if we produce less, right? And that is what we call an under recovery situation. Okay, that's what we call an under recovery situation. So let's have a look. Let's have a look at this now. You guys, you have to pay attention while I'm speaking so that you don't fall behind, right? So we started off with 200 Rand, right? Rental for the year. We had 200 Rand rental for the year. Okay. Our normal capacity or our plan, what we planned to do was 20. So therefore, what is our estimated cost per unit? What's our estimated cost per unit? Right? Our estimated cost per unit is going to be 10 Rand. How did we get that 10 Rand? We said 200 Rand, right, divided by 20 units. Happy? Right? That's how we got the 10 Rand. Now, the next question is, how much did we end up allocating during the year? Right? So we only produced 18, right? Which means we then would have said 18 units, right? I'm going to put a little u there so that you don't get confused. 18 units, we multiplied it by the 10 Rand. Where did we get the 10 Rand from? The 10 Rand was the allocation rate that's basically come from there, right? That's where the 10 Rand has come from, right? And that's going to give us 180. Everybody on track? So far, anyone lost? Anyone lost so far? You don't understand how we got the 180, you don't understand how we got the 10 Rand. Right? Okay, so everyone's comfortable so far. Right. Now let's have a look at sort of the answer. What does the answer look like? What are we supposed to do now? Okay, so we said, all right, so we got the 10 Rand. That was correct. We managed to calculate that. Then we said the 10 Rand from here, right? The application rate, the allocation rate, 10 Rand, right? Multiplied by the 18 units, which is what we produced during the year, right? What our actual production was during the year, right? And we call that actual production, we call it actual. You see what we call it? Actual capacity, right? And so we allocated 180. Okay. Now, like we said before, we said let's assume that we can accurately estimate the fixed production overheads. So the estimation, so this 200 Rand is actually what we paid. Okay, we can accurately estimate the fixed production overheads. Okay, so now let's have a look at our tier. Everyone's happy, right? Let's have a look at our tier counts. Okay, so this section here hasn't changed, right? So this one is the same as the previous one. We debit the rental income, let's say, right? So that's bank, right? So we paid it, we credited bank, we debited the income, we paid the landlord 200 Rand. Happy. Now we moved this 180 into another account, and we said for our purposes we'll just call it inventory for now, right? We've moved that 180 into inventory. Okay, we've moved it from here, so that's that journal entry there, going in there, 180 to inventory. Okay, and then it's from there it's been moved into cost of sales. Now the problem is we are telling everyone that it cost us 180 Rand to produce these goods. Right? We're telling them via the cost of sales account. We're telling them it cost us 180 Rand to produce these goods. How much did it actually cost us? It actually costed us what? 200 Rand. Right? Which means our cost of sales is now too small. In the previous example, our cost of sales was too big. You remember? Now our cost of sales is too small. So we need to pass a journal entry called an under recovery journal entry, which is where we move the remaining amount, the amount that's left over in the expense account. So now I'm going to change my color because maybe that was what people were not understanding. So I'm going to change my color. So we're going to move this remaining 20 Rand, the amount that was never allocated, never got allocated, we're going to move it into cost of sales. And that's going to bring our cost of sales account now up to what is the final balance? It's going to be 200 Rand, right? Right? It's going to be 200 Rand, which means what? It equals what was actually incurred. Now, have a look at this, where at the end of the day, right, when everything was finished, our cost of sales equaled what was actually incurred. Now, go back to the previous example. What happened here? Our cost of sales, which ended up being 200 Rand, right? Why 200 Rand? Because we brought 220 in. This is the previous example, guys. This is the previous, it's not the current one. This is the over recovery example, right? In the over recovery example, the 200 Rand at the end of the day, at cost of sales, equaled what was actually incurred. Yes, someone had their hand up. You want to put your mic on? Do you want to put your mic on? No. You can type it out in the chat if you have a question. Can you see in both examples, the end, the final goal or the final situation is the same. The final goal, the final situation is for cost of sales to equal what was actually incurred, right? We just have to pass that journal entry to make sure that happens, right? That's what under and over recovery means. Okay. Right, questions now, guys. Everybody on the same page. Everybody understands. Okay. Right. Now let's look at this from a theoretical standpoint, right? So now we're just going to talk a little bit about theory. Right. So we said now, with the fixed production overheads, it's not like, please go to the previous slide, someone says, this slide here. Okay. Yes. Okay. So now, with the fixed production overheads, right, we said the problem is we can't allocate it like we do the variable and like we do the other, the direct and direct material, direct labor, right? There's no direct link. So we have to use this thing called normal capacity. Normal capacity is never equal to actual capacity, right? So we have a situation where the amounts that we allocated, right, can sometimes not equal the amounts that we incurred. Does that make sense? Right? The amounts that we end up allocating don't always equal. So what I'm trying to say here, right? The amounts that we allocated is this amount here that's going to whoop. that amount of 180 is not equal to the 300 to the 200, right? It's not always equal. So that's what this statement is saying. On the right hand side, this statement is saying that, right? The amounts that we incur, the amounts that we pay, sometimes might not equal the amounts that we allocate into the inventory balance, right? So then we now need to do either an over recovery or an under recovery, right? And our rules are, if the amount that we allocated is more than the amount that we incurred, then we must do an over recovery journal, meaning we need to decrease cost of sales, we need to increase our fixed overheads, whichever they are, whichever overhead we're talking about, right? And a characteristic situation of when we have an over recovery is when our actual capacity is higher or greater than our normal capacity. So when you're reading the question, guys, when we're reading the question, we can identify immediately a situation where there's an over recovery and immediately where there's an under recovery, because we can say, okay, if our actual is higher than our normal, it must be over recovery, right? Inversely, if we allocated less than we incurred, we need to do an under recovery journal. And an under recovery journal does what? It increases cost of sales, makes the cost of sales bigger, right? To make the cost of sales equal to what was incurred, right? And so that would be a debit journal, right? So this journal here is going to be debit cost of sales, right? And credit fixed. I'm just going to say fixed overheads, right? This one is the opposite. This one will be debit the fixed overheads, and it will be credit cost of sales. Okay, so we're making cost of sales smaller in the top journal, making cost of sales bigger in the bottom journal. Does everybody understand that so far, right? Right, so that is the whole story behind under and over recovery, right? That's the whole spiel. Now, I just want to, I had planned to do more examples with you guys, but we had gone a bit slow at the beginning. We had been slower than I had anticipated. Let's start off with this example, but we're obviously not going to be able to finish. And then what I need you to do is I need you to go home and finish it off, on your own, right? And then come to me with questions, right? So we'll start it off now. We'll start this example, but I know that in 6 minutes we won't be able to finish it. So we'll start it off and then you guys finish it for me at home. Okay, so we're told here we've got normal capacity. Remember, normal capacity is budgeted. Some people are saying they're already at home. Normal capacity is budgeted. And remember, normal capacity is always in what? Units. Yes? Normal capacity is always in units, right? So we've got 100,000 tables, right? So in this example, we're making tables, right? Got 100,000 tables, right? Okay. So then we're told we've got factory rental of 20,000 per month, right? And we then got machinery depreciation of 10,000 per month, right? It then tells us assume that the actual is equal to the budgeted overheads for the year. Okay. So far, is everyone comfortable with that story? Any questions about what we read in the? So you guys need to zoom in on your side, right? You need to zoom in to see it as clearly. So you just need to click the zoom button. The zoom button normally on the top left-hand side, right? Okay. So here what we've gotten is we've gotten units in years, right? But what have they done with the overheads? They've given us it in months. So what we need to do is we need to compare apples with apples, you see? So we need to come to a situation where where we're going to have the factory rental in years, or the factory rental in a year amount, and the machinery depreciation in a year amount, right? Okay, so we'll come to that just now. And then it says at the end of the year, we're told that we actually produced 110, right? So now you just assume that you can't see the rest of the, I know you can, but just assume you can't see the rest of the question. Can you tell me, is this going to be an over or under recovery? I just want the word over or under in the chat, right? Is this going to be an over or under recovery? Remember what we said in our previous example, right? We said we can tell by just looking at the question if it's going to be an over or under recovery, right? So everyone is saying over, 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 right? That's correct. It's going to be an over recovery. But what does that over recovery journal look like? What does that over recovery journal look like? We do what? Who do we debit? We debit the overheads, right? Remember, we're trying to make the overhead. Now we've allocated too much. Yeah? So we debit the overheads, and then we're going to credit our cost of sales. You see that? Right. So let's have a look at what this looks like. Right. So then we say we've got 20,000 rental times 12, right? Why 12? Because there's 12 months in the year, right? Then we've got 10,000 depreciation, again times 12 for the same reason, because there's 12 months in the year. That's going to give us 240,000 plus 120. Right. So our total overhead, therefore, is going to be 360, right? You know how we got the 360? We added the two up, right? We added the 240 and the 120. We added it up and we got 360, right? And then we divided by the budgeted table, the budgeted units, right? The normal capacity. And that's going to give us 3 Rand 60 per unit, right? And in our case, we're going to say 3 Rand 60 per table. Okay. Now, how much are we going to allocate? What does that allocation calculation look like, right? We've got the 3 Rand 60. We're going to multiply it by which amount in the question? Which amount are we going to multiply it by in the question? Someone's given us the answer there, but the amount that we want to allocate, we want to multiply it by, is going to be the actual, right? It's going to be the actual. And the actual, oh, why did I say Rand? And the actual is 110 units, right? The actual is going to be 110 units, right? And that is going to give us the answer of 396,000, right? So that's what someone has said in the chat. That's what we've got here. We've allocated 396,000. What have we done? We've taken the actual production multiplied by the absorption rate, right? Absorption rate. Okay. Right. Now the problem is we have allocated 396,000 to inventory, but how much have we actually paid? We've only paid 360, right? So we've got a situation where we've overinflated the value of inventory. We've made the inventory look too big. We've over-recovered, right? How much have we over-recovered by? We net the two amounts off and we realize we've over-recovered by 36. You see that? Right. Now let's have a look at the journal entries. Let's see if we agree with what the journal entries are telling us, right? So we're going to have here bank debit on the debit side of the expense, right? Which means we credited it, right? We're also going to have depreciation, right? Which means we calculated depreciation. We then moved that depreciation, and when we calculated it, we would have said debit depreciation, credit accumulated depreciation. We then moved that depreciation out of that depreciation account into, let's say, our overheads account, right? And then we've moved it from the overheads account into inventory. Let's just call this, I know it says work in progress, let's just call it inventory, right? Everybody comfortable, right? And then we had a situation where we've over allocated, okay? So we need to then decrease our cost of sales by 36. Okay. Now, the next example I'm not going to do with us in class, but the next example is dealing with, and I think you can see it right from here, the normal capacity is 100,000, right? What's our actual capacity? 80,000. You guys are going to type out now in the chat for me, is it an under or over recovery in this situation? Under or under recovery, right? Now, in the next example, what they're going to do is they're actually going to do the journal entries, right? They're going to do the journal entries. So I want you to go and have a look at the journal entries. You can sort of grasp the journal entries from the T account that we just did in class, but it's also nice just to look at it on your own, right? And see it for the way they produced it. Okay. Is everybody comfortable? Now, I'm going to do consults immediately now because I do realize that maybe some people were struggling with some of the concepts. So we can go straight into consults, but for the long and short of it, the lecture is over. Okay, so thank you very much for coming and have a nice long weekend, and I'll see you on Tuesday.